The market is freaking out again, I know. Now, I'm not freaking out, and I know the bull run is not over, which is why I hate to even get too far into it, but you may have seen there's panic posts everywhere, traders calling tops, and headlines all over different media outlets claiming the move is over. But is it? I don't think so. I think this is just a shakeout before the next leg higher in the bull run that we are in. Now, why? Why do I say this? I say this because institutional flows are still pouring in. Liquidity is still expanding, and the data itself, which you know is how I like to base my opinions, still shows we're sitting right on top of one of the strongest foundations of this entire cycle. The bull run just looks different this time. So today we're breaking down what's really happening with Bitcoin, why this pullback was expected and even needed, and how the same forces behind every major run, this bull run, that is ETFs, liquidity, and adoption, are all still lining up and with force again. So by the end of today's episode, I'll show you exactly what's coming next for Bitcoin, why I say it, and the broader crypto market. And most importantly, how to position yourself before it hits. So if you're ready, let's get into it, and happy Friday, guys. And I'm so sorry I didn't come to you guys yesterday. We were traveling back, but I'm here and I'm very happy to be back. Starting with Bitcoin as we do, we see that Bitcoin actually ended up hitting every downside target we mapped out earlier this week, targeting that support zone around 119,000, right where the last breakout sat on the weekly chart. That retest is healthy, guys. The real question is whether bulls, as they say, can defend that zone and close strong, or if it turns into a deeper reset. The pullback came from one main factor, one of the main factors affecting the entire bull run, and that is ETF inflows. This week, Bitcoin ETF saw record demand. And when this much money floods in at once, the markets need to cool off. So that's what we saw. 3 red daily candles in a row shook out short-term traders. Also needed, I would say. But that kind of move usually appears right before the next leg higher. If we take a look at the fear and greed index, it dropped to 64, showing that some of the excess optimism has finally been cleared out, which once again gives us room to go higher. So this is a very healthy rotation we're seeing, not capitulation. And right now, the line in the sand sits between 117,000 and 119.5 thousand. A strong daily close from here would confirm that this is a shakeout, clearing leverage before the next impulse. And if we close red again, it could mean one more dip before the market regains footing. So watch volume and dominance. Reclaiming 120,000 on strong spot volume basically signals real buyers are stepping back in. And if USDT dominance, sitting near 4.44%, rolls lower, it would mean stablecoins are flowing into crypto. And if it spikes towards 4.8%, that would warn us of a short-term risk-off behavior. Bitcoin dominance near 61.6% shows where we are in the rotation of things. This is usually the point where Ethereum and larger altcoins begin to catch a bid. And if we zoom out, the structure still looks bullish. Bitcoin has already reached the measured target from its early year breakout pattern, and gold, silver, and the S&P followed the same setup in previous cycles and then kept climbing. So if Bitcoin follows that path, this pullback is setting up the next major move as institutional flows stabilize and liquidity expands again. Now, if we shift gears and talk about ETF inflows and outflows and what is going on the institutional level, as I believe these forces have had a huge effect on the market and continue to and will continue to. We see that on October 9th, Bitcoin ETFs pulled in another $198 million, while Ethereum ETF saw a small $8.5 million outflow. Now, that's a normal rotation of capital. Bitcoin is still commanding the bulk of new inflows, while Ethereum takes a breather after an 8-day, $2 billion run-up. So even after the cool down, combined ETF trading volume has stayed above $2 billion a day, which tells us institutions haven't stepped back. which is crucial in knowing where we're going as a market. They're still repositioning rather than leaving. And Matt Hugin from Bitwise says inflows into Bitcoin ETFs are on track to set a new quarterly record. These products have already attracted $22.5 billion in the first 9 months of the year and could finish around $30 billion, a level that matches some of the largest equity ETF launches ever. And he describes it as part of the debasement trade, something we talk about all the time, which is the rotation of capital toward hard assets as the dollar is weakening in value, meaning investors are looking for somewhere stronger. They're looking to put their money in hard assets because the dollar is failing. So what makes this different from earlier cycles is access. Wealth management platforms are finally unlocking crypto exposure for clients. And when giants like Morgan Stanley open the door to 16,000 advisors, it means ETF inflows are no longer limited to crypto native funds. They're now tied directly to mainstream portfolios. And the result is a constant drip of institutional liquidity that underpins every pullback and keeps this cycle and will continue to keep this cycle structurally bullish. This is why I believe, and I've said it again and again in my videos, we even saw that Arthur Hayes agreed and wrote his own post on this, saying that we have broken away from the 4-year cycle. I truly believe it more and more. Bitcoin has broken away. Bitcoin's cycle, bullish cycle top, is going to look very different, and it's going to be much more prolonged than all previous cycles. I'm just calling it. I may be wrong, but I really believe so. Next, now let's shift gears to talk about what's going on the macro level of things, because the big picture always informs the smaller picture, right? The puzzle piece always fits within the larger puzzle. So right now, we're hearing that the New York Fed, John Williams, just called for more rate cuts this year. That's a major signal that policy is shifting from defense to support. And if this were to happen, if rates were to fall, we would see liquidity expand. Since liquidity is the oxygen markets run on and need in order to move, it wouldn't just end up helping risk assets. It would reignite everything from equities to crypto, because cheap money, as it would be since interest rates would be lower, would be looking for performance. They'd be looking to put their money to work and perform for them. So where do you think that might go? Crypto. And on the retail side of things, participation is heating up again. Morgan Stanley's data shows everyday investors bought $105 billion worth of US stocks in just 1 month, which is the largest inflow ever recorded. And retail demand has multiplied 5-fold since April. And historically, those flows spill into crypto once risk appetite returns. So liquidity is now flowing from both ends. Top down from institutions on the one hand and bottom up from individuals on the other. So very much so is the perfect storm brewing. It's just taking longer because this time we have institutions at play with us in the playground of crypto tokens and the crypto market. So everything has just expanded and grown in nature, including the cycle. That said, we're also hearing that State Street, which manages over $4.3 trillion, says 60% of institutions plan to double their digital asset exposure within 3 years. Do you see why I think the bull run's going nowhere? It's just been prolonged, stretched out. And more than half expect up to 25% of their portfolios to be tokenized by 2030. That means Wall Street is no longer testing crypto. It's not a question of if. We see Wall Street is integrating crypto. It's going nowhere. And Deutsche Bank analysts also project that central banks may hold significant amounts of Bitcoin and gold by 2030, treating both as modern pillars of financial security. So they see Bitcoin's role evolving alongside gold and not replacing it. They see it as standing beside it as part of a diversified global reserve mix. So if we pull it all together, easier monetary policy, record retail flows, we see institutional adoption and sovereign interest growing. So we see the macro backdrop looks almost identical to the conditions that has fueled every major bull run phase before, except the monetary policy and the institutional adoption and sovereign level are on steroids this time. Well, most people are just glued to the price, which hopefully is not you, and hopefully you have a larger and a better grasp on fundamentals and macro conditions that affect the market. We know that what's changing beneath the scenes, behind closed doors, okay, not always publicized on media outlets, is far more important. The wiring of global finance itself, the infrastructure of money is being rebuilt in real time, piece by piece. And this is the part of the cycle most people miss. They get discouraged. They don't understand, which is why we have to invite them to come follow my channel and join our community, because we are in the nitty gritty here. We are following all these details closely, and we do have a handle on what's going on in the market. Hence why we're not growing impatient, and we know it's just part of the game. We're even hearing from Multicoin Kyle Samani, the CEO and founder, I believe, and he's calling this internet capital markets, the financial systems that live fully on chain, settle in seconds, and never close. What used to take days in traditional markets now clear instantly. And that speed is starting to pull legacy players into the mix. And we even see that the NASDAQ is preparing to support tokenized stock listings and trading, bringing traditional equities onto blockchain rails. That move bridges Wall Street liquidity with crypto native settlement, a match made in heaven, if you could say it that way. Meanwhile, stablecoins have crossed 1% of US M2 money supply, quietly becoming a public dollar-based payments network that runs 24 hours a day, 7 days a week. And the NYSE's parent company, Intercontinental Exchange, just also announced its plans to invest up to $2 billion in Polymarket, valuing it near $8 billion. Now, that's a major traditional exchange directly funding an on-chain order book, the kind of crossover we've been waiting for. And now the S&P 500's parent company has launched the Digital Markets 50 Index, giving institutional investors a simple way to gain exposure to Bitcoin and the broader crypto market. Index inclusion is how traditional capital locks in. And once it's in the benchmark, it becomes part of every portfolio that tracks it. It's the very plumbing of the new financial system that is locking into place. Issuance, trading, and settlement clicking together like gears. Each integration makes the next one inevitable. And step by step, the future of capital markets is moving on chain. Now let's talk about Solana, because we know it's a big giant and mover this bull run. Right now, we see liquidity is tilting towards Solana right before the ETF deadlines, and the data shows smart money positioning itself early, of course. Today is the day that the SEC faces its final deadline on multiple Solana ETF filings from Grayscale, Fidelity, VanEck, and others, each with roughly 95% odds of approval, according to analysts. And JP Morgan estimates that Solana's ETFs could bring in around 1.5 billion in their first year. Now, that may be smaller than Ethereum's debut, but it's still a major vote of confidence. Meanwhile, the Solana Foundation continues accelerating corporate accumulation through its discounted digital asset treasuries, fueling ecosystem growth. Add it all up, ETFs on deck, foundation-backed treasuries, and liquidity rotation, and Solana's narrative is clearly building into this cycle. And what I find very interesting, and I couldn't align with more, is what we're hearing from. Now let's talk about the cycle setup we're seeing. According to Global Macro Investor Cycle Top Finder, Bitcoin is still early in its bull phase. The indicator remains far below previous cycle peaks. Every Q4 tells the same story: pump, shakeout, violent reversal, and then we see a full send-off or full pump. And that's exactly where we are now. Deep in the shakeout phase, volatility is back, sentiment flips from greed to fear overnight, and every candle looks bigger than it really is. These are the moments that test conviction. This is why we need to zoom out. It's like staring too closely at at anything. It looks larger than it is, because when the market moves like this, it's not a sign of weakness. It's how the cycle resets before it expands again. And all it takes is one strong day of inflows or a clean breakout to push Bitcoin and Ethereum straight back up into price discovery. The higher time frame trend still points up, and the macro tailwinds behind it, liquidity, adoption, institutional demand, etc., they are all stronger than they've been all year. The playbook hasn't changed. Shakeouts clear leverage, strong hands reload, which is good for the whole space, for all our bags. And when the dust settles, the market rewards patience. So I would ask you just to be patient. So as we close out today's video and our videos for the week, this is where we stand. The Fed is easing. Institutions are doubling down. ETFs keep piling in billions. And the rails of finance are moving on chain. All while Bitcoin just completed the same kind of reset we've seen before every major breakout. So don't make it into more than it really is, although time will show what really is, but this is what I really believe. What we do have to accomplish, though, is we have to see Bitcoin holding this $117,000 to the $119,000 range. We have to see it close strong, and then this will become the higher low that launches the next institutional leg higher. The shakeout phase is almost over, and what comes next is the part of the story where conviction will pay off. So I hope you do hold on once again. That's it for today's video. We'll keep bringing you the top research, real market signals, and the most promising projects, so you're ready to capture every opportunity this bull cycle has to offer. Thanks for tuning in, guys. I love you so much, and I'll catch you guys in my video on Monday. Ciao.